In this video, I'm going to talk about two important things that you need to look at when you analyze the performance of the Indian stock market. I'm sure you're all aware that the Sensex has recently hit 50,000 for the first time in the Indian stock market history. But since then, over a matter of just 1 week, we have seen an 8% drop in its value. So what's happening? I'm sure you're all asking yourselves, should I invest more or should I just take away all my money and book my profits? We'll answer all those questions in today's video, so make sure to stick till the end. Hey guys, welcome back to Finance with Sharan. In this channel, we explore the incredible world of finance and how it can help us better our lives. So the first thing that we need to look at when you analyze the health of the Indian stock market is the Buffett indicator, named after the legendary investor Warren Buffett. So Buffett indicator is nothing but the ratio of the market capitalization of all the listed companies in India divided by the GDP of India. So market capitalization is nothing but the perceived value of the company in the stock market. For example, let's say that a hypothetical company has 100 shares and each of these shares are worth 10 rupees. So the market capitalization of this company would be 100 into 10, which is 1000 rupees. So if you do this exercise for all the listed companies in India and add it all up, you get the market capitalization of all the companies in India. So now GDP is nothing but the monetary value of all the finished goods and services produced within the borders of India. So now when you divide these two parameters, that is the market capitalization of all the companies in India divided by the GDP of India, you get the Buffett indicator. So if you think about it, the Buffett indicator is actually the ratio of the perceived value of India divided by the actual value of India. Because the stock market gets its value based on the perception of the investors in India. And the GDP is the actual value that India is generating. So according to Warren Buffett, in the context of the US stock market, if the Buffett indicator, that is the ratio of the perceived value to the actual value, if that ratio is 70 to 80%, then it's a good time to buy. But if it reaches 200%, which is what happened during the 2001 dot-com bubble, then you're playing with fire. And as we talk, this ratio is 190% for the US stock market. But why are we evaluating the US stock market? Because unfortunately, what happens in the US doesn't stay in the US. The ripple effects are felt across the globe, including India. Now, if you look at the Buffett indicator of India, it's about 100% as we speak. While this may be significantly lower than the US stock market, you need to look at it from the context of the India stock market history. The highest the Buffett indicator has ever reached for India was 149% during the 2008 financial crisis. After it reached 149%, India's stock market fell by nearly 60%. Another reason why the current 100% Buffett indicator of India is alarming is because the unorganized sector is not accounted for in the Indian stock market, but it is accounted for in India's GDP. The proportion of the unorganized sector in India is significantly larger compared to that of the US. So if you were to include the unorganized sector as well, the Buffett indicator of India would shoot up as well. The second macroeconomic parameter that you need to look at when you analyze the health of the Indian stock market is the PE ratio. Now the PE ratio is defined as the ratio of the share price of a company to the earnings per share of that company. Now if you assume a hypothetical company A whose share price is 1000 rupees, the number of shares is 100 and a net profit of 10,000, the earnings per share is calculated as 10,000 divided by 100, which is 100 rupees per share. Now the PE ratio of this company A is the ratio of its share price, which is 1000, to the earnings per share, which is 100, giving us a PE ratio of 10. So what this means is that we are paying 10 rupees for every 1 rupee profit that the company is generating. Usually, the PE ratio of a company is compared against its peer group companies to understand whether it is undervalued or overvalued. Now if you do this exercise for all the listed companies in India, you can arrive at the PE ratio for the Sensex or Nifty. Now historically speaking, the Indian stock market has always plummeted or underperformed once the PE ratio hits 24. For example, during the 2001 dot-com bubble crisis, the PE ratio hit 29 and we saw a 50% drop in the value of the Indian stock market. During the 2008 financial crisis, the PE ratio was 24 and we saw a 60% drop in the value of the market. Guess what the PE ratio is today? As we speak, the PE ratio of the Indian stock market is a staggering 36 times. By looking at these popular macroeconomic indicators, it is clear that the Indian stock market is overvalued. But is looking at historical data alone enough to make decisions about the stock market? Because the stock market is not built on fundamental scientific principles. What I mean is that you can't just look at the historical data and extrapolate it into the future. The stock market, if I may, is almost like a living entity. It is representative of the collective opinion of millions of investors in this country. At the beginning of this video, I told you guys that after watching this video, you will be able to figure out whether to invest more or to book your profits. Well guys, the truth is nobody can answer that question. To put that question into perspective, it's like asking, what will millions of investors in India do in the coming months? Will they invest more money or will they book their profits? So regardless of the true intrinsic value of the stock market, the Sensex will move up or down based on what majority of the investors think. A great example of this is what's currently happening with the GameStop stock. So even if a few of us think that the markets are overvalued, which in my opinion it is, it doesn't matter until enough investors think so. If enough investors think that there is still room for growth, the Sensex will also increase to 60,000 in the coming months. You can never know. So what should you do? Well, in my opinion, trying to time the market, that is buying at the lows and selling at the highs, is one of the most, if not the hardest things to do. So the best way forward for you guys is to start an SIP, that is a systematic investment plan. Let's say for example, you have 5 lakhs in savings that you would like to invest in the Indian stock market. Instead of investing the entire 5 lakhs in one shot, you could divide it over a period of 6 to 12 months. That way, if the market does go down, you get to buy it at cheaper prices as the months go on. On the flip side, if the markets do go up, then I'm sure nobody is going to complain. This concept that I just talked about is called rupee cost averaging, wherein you strategically average the cost at which you are entering the stock market. If you guys have watched this far, then I'm sure you must have gained some value out of this video. If so, then please smash that like button and subscribe to my channel. Also hit the bell icon which is next to the subscribe button so that you can get more videos like this as soon as I make them. If you guys want to know exactly how much proportion of your money should go into stocks, then I encourage you to watch this other video that I have made, wherein I explain exactly how to create a customized financial plan for yourself based on your financial goals. And trust me guys, it's not the generic 100 minus age rule, which does not make sense to begin with. I'll put a link to that video in the description and somewhere about here. Alright guys, with that I'll wrap up this video and I'll see you in the next one.